Welcome to my very first finance YouTube video. Today we're going to be looking at a very special topic called the cost of finance. And we're going to be looking at it from the perspective of an Australian bank. So Australian banks have to get finance to run their business from a multiple different sources. One source of finance, of course, is your savings account. So if you put money in your bank account at the bank, that's money that the bank can then use to lend out to creditors, to lend out to people using credit cards. That's a source of finance for them. And the cost of that finance might be a variable rate that they've set. I can think of one bank at the moment who gives a 4.75% return on your savings, which they pay monthly. And that's a variable rate. The variable rate means that if the Federal Bank of Australia, if it drops the reserve rate, then they may drop the rate that you get on your savings. So it's not always going to be 4.75%. If the Reserve Bank increases the reserve rate, you might get a higher rate of interest. But if they drop the reserve rate, then you'll get a lower rate of interest. So savings. And savings are a product of the bank. So they market that product as a product to you, their customer. So another way they can get finance is through senior loans, also known as bonds. So this is when banks lend to one another, insurance companies lend to banks, large institutions, they lend money to each other. And this has a very low risk to the people who's lending the money, because what it means when it says it's a senior loan, it means that if the bank gets liquidated, if it means the bank goes bankrupt, those loans get paid to those creditors first before anyone else gets paid. That's why it's called a senior loan. Of course, and after that is a junior loan. So junior loans get paid after senior loans get paid if the bank was to get liquidated and sell all its assets because it went bankrupt. And these are another type of bond, which is known as subordinated debt. So whoever lends the bank money with a junior loan, they're taking on a slightly larger amount of risk than those who've given them a senior loan. So they'll get a higher interest rate to compensate them for that higher risk. And so senior loans are very low risk. They might still be at around 3%. Junior loans are much higher risk. You might be able to find them for around 6% at the moment. And yeah, and so to the person who's lending the money, this 3% return, this 6% return, that's a return. But to the bank, it's the cost. It's the cost of receiving that money and the cost of using that money. And so as we go down this list, the cost of finance is going to get greater and greater and greater. So next, after this, is what's known as hybrid securities. So hybrid securities are usually listed on a stock exchange, and they are a hybrid, hence the word hybrid, between bonds and stocks. So bonds are just loans, but stocks are when you own a percentage of the company. So, and you might be able to find them for around 7%. So these are also known, particularly in the US, they're known as preferred equity. And they were first developed actually with railroads in the US, when railroad workers would get equity as a part of their payment compensation, but they didn't want the same kind of equity that everyone else got. They want equity where they would get paid first. So preferred stocks, they get paid dividends, not interest. They get paid dividends, usually at a fixed rate. and if the company has to cut any of their dividends, they'll cut the dividends of their common stock before they cut the dividends of the preferred stock. So it's a more stable kind of income. And so, of course, as we mentioned already, we have the highest cost of finance is common stock. So it's actually selling a part of your company, selling ownership of your company. And the cost of that finance is your profit, because whoever owns your company owns the profit that you make. So it's the most expensive kind of finance that a company can give. And typically banks, even in Australia, over the long term, they might make 10 to 12% return on equity per year. They might make a 10% profit on each year. So it's the highest cost of finance, but it's also the highest risk that people can take on. Because if the company was to go bankrupt, you might not get any of the money you've invested in the company back. Of course, when we're thinking about Australian banks, the risk of that is kind of low, and also we might think that if the company goes bankrupt, the government might step in to keep the company afloat. So you might not consider it very risky at all. But it's also risky because even though they make 10% a year on average, some years they can make a negative return and have a negative return of 10%. Some years they might have a positive return of 25%. So it's a lot more risky. And if you invest $10,000 today, there's no guarantee that it'll be worth $10,000 in a week or a month or 2 months or a year down the track. Which brings us to the investment time frame. So usually for stocks, we say the right investment time frame would be 7+ years. Whereas for all of these senior loans to hybrid securities, you could probably hold them for a shorter amount of time. And because their prices don't fluctuate as much, you can still generate a return without getting into too much risk. And of course, in your savings account, you can put money in there today and take it out tomorrow, and you won't lose anything. So the investment time frame really is anything that you want. So here we come to a bit more of the conceptual part. So if you own common stock, you have ownership of the company, and you have ownership of the company, and it's which is why you've taken on the highest amount of risk. And hybrid securities, technically they're also a kind of ownership, but with preferred dividends. If you have given the bank a senior loan or a junior loan, I want to say that you're a partner. You're a business partner. You've provided them with equity. You've provided them with finance at a specific rate of return through a business arrangement. And if you put money in a savings account, who are you? You're just a customer. So most people, when they think about investing money or putting their money in a bank in order to get a return, you'd usually think about some kind of savings or term deposit or something like that. But in that case, you're just a customer. You could elevate yourself to being the bank's business partner by investing in senior loans or junior loans, maybe through an ETF listed on a stock exchange. Or you could even elevate yourself to a position of ownership where you take on the most risk, but then you receive profit from the company at a higher rate of return on average. Because otherwise, why would banks issue hybrid securities? Why would they issue junior loans? Why would they issue senior loans if they know they have to pay back money on those? They know they have to pay back 3%, 6% extra interest over the money that you've given them. Well, it's because it has a lower cost of finance towards their common stock. They could issue common stock, but then everyone would be getting like a 10% return on average. So hybrid securities, junior loans, senior loans, they have a lower cost of finance, which is why they're issued. They make the banks more profitable. So if you think about it from that perspective, if you're just a customer at a bank and you're putting your savings in there at a 5% rate of interest, the only reason the bank offers that product is because they know that they can make more than 5% on your money. And so if you want to participate in something that's more profitable, you move down the list to whatever your investment time frame might be. So if you want to increase your return, but you still might only be investing for a short period of time, maybe hybrid securities or subordinated debt would be a better investment, where you could get a better rate of return but not lock your money in for as long. So that's my investment video for today. It's my first investment video, so please like and subscribe and enjoy your day.